Kenneth Andrade, founder and CIO of Old Bridge Mutual Fund, joining in this morning on Talking Point. Kenneth, a very, very good morning to you. And thank you so much for coming in and speaking to us. You know, just because top of mind is Jack Dorsey, block AI-related job cuts, and only our IT sector doing okay right now. I just want your take on that. Are we in India as well, and in the Indian context, going to see that kind of upheaval on jobs and then discretionary spends coming out of it?
Well, Tamanna, I don't have that kind of foresight, but I think we'll find our way through this, right? There is definitely going to be a little bit of pressure in terms of cash flows, at least in the near term, in terms of how technology will reshape the underlying the underlying employment cycle that is there. But we'll just have to take it step at a time. Obviously, the good news or the bad news is that in the near term, the good news is that in the near term, I think you won't see too much of that happening. In the longer term, as technology evolves and as we embrace a lot of that, there might be near-term pressures that will exist out there. So net, I think wait and watch. Obviously, there'll be pressure on profit margins that are there from a lot of companies, especially in the IT services sector and anything that's got to do with technology. But the brighter side of it is that there will be a lot of capex that is also coming out there to enable this cycle that is there, and that itself would create a reasonable employment opportunity out there. So it's a mixed bag in the medium term. In the longer term, obviously, I mean, like I said, I don't have that kind of foresight to see what's happening, but obviously, automation will have its impact on how the current format of employment uh, structure is. It'll definitely change.
Kenneth, good morning. Neeraj here. It's been a while, but I look forward to this conversation. How do you see the current structure as well, Kenneth? A lot of people were talking about the need for the US trade deal to fructify, for the market to find a fresh lease of life, if you will. Otherwise, it's stuck in this range. Somehow, post those developments, and I don't know if it's a done deal as yet, it seems that we kind of stuck in a range, unable to blow hot or blow cold for whatever reason. Does this continue, or will it take an earnings revival to take the markets out of this very tight range, if you will?
So there's not great good news for 2026. I think last time we had this conversation, I did mention something very similar to 25 will evolve in 2026. There are two parts of this that is happening. One, India has been stuck in this single-digit earnings growth rate for like now 2 years. We probably still have it in 2026, 27. The consensus is saying something different now. All of that is happening within the country itself is the lack of demand to kickstart the economy, which is why we have to rely reasonably on finding newer markets. And the good thing about this trade deals that are coming through is it's okay as far as the US is concerned, but the bigger one, I think, is the European Union structure that is falling into place. Now, when you have both these trade zones opening up, whether it's the US and the European zone put together, you're addressing at least 23-24% of the world population with reasonable amount of spending power. And that should create another leg of opportunity that is there, or another leg of demand that is out there, which is why all of this was reasonably critical for India as an for Indian manufacturers and in Indian businesses. Without these two trade deals, I think the capex cycle wouldn't have come back. And now that you've got these two transactions on the table, all of it will start showing up in 2027, 28, 29. Okay, and I think that's the timeline that you need to work with.
So on the one hand, Kenneth, you're talking about any good news which has been announced or announcements actually showing some impact, fructifying post 2027. On the other hand, are the negative news flows. Now, this whole thing about criteria for F&O participation, Ashish Chauhan has been quoted as saying this, that maybe it could be required, a minimum qualifying criteria. You're seeing all capital market stocks also getting bludgeoned. How much of a pain point is this sentimentally for markets and for capital market plays, which were the hot favorite, at least for the first half of calendar year 2025? Do you think that tide has turned significantly now?
This is, I mean, from a capital market perspective, this is an ongoing cycle that you've seen for the last 3.5, 4 decades, right? And I haven't seen anything that has been done from a regulatory standpoint which has not grown the capital markets. So I think we have to take this in our stride. If things become a little difficult, there will be corrective actions in future. So don't stand at the judgment seat for what happens in the near term. What the longer term things have fallen into place. Um, okay, when it comes to company stocks, etc. Okay, one of the biggest deterrent is how for businesses to correct or stocks to correct is also not just the business environment, but is also where the valuations and how perfectly they are pricing the market opportunity at this point in time. So any positive or any negative news does have a sentimental impact and does have a trading impact to all of that. So all said and done, I think look at it from a position of it's an ongoing cycle that is there. Stock corrections usually happen not because of there's something that is detrimental to the industry, but simply because they're also priced to perfection in some cases.
Okay, so that's a problem with capital markets. What do you think is ailing BFSI? BFSI, I would say if you're looking at an AI safe trade, that is there, economy is doing okay, you should be looking at BFSI. FIIs have reason to come back, BFSI should be doing well. But you're not really seeing that pop, is it? To your mind, Kenneth, what is the concern there, if any?
You see, that's an industry that has done extremely well over the last 2 decades. Like all market capitalization and all market leadership came from that category itself. Now it's taking a breather, and it's also become a significantly large part of the entire economy as well as the market capitalization. To say that it's going to go from 30% of or 35% of market cap to 50% of market cap, I think that's a little bit of a stretch. So net, let's put it this way: these companies are good. Some of them are great. They will tend to be market performers to try and build earning cycles or business cycles that are growing faster than the entire economy. It will be relevant in a company 2 or 3, but I don't think it's going to be relevant for the entire industry. So our perspective out there is look for companies and businesses on a selective basis. So you have to be selective in an industry which is this large, and you will definitely get stock opportunities out there. Buy a category just because it's a large part of the economy, and I don't think that's investing really. That's allocation. So in a sense, it's a relevant part of the economy. It's a relevant part of people's portfolio. You have to pick the right businesses and companies there if you want to get if you want to build alpha through your portfolio. So be selective in that space. I don't think you need to just allocate to the business because it's a large part of your economy.
Got it. Kenneth, you look at cycles fairly closely. One of the things that came in the wake was with this FDA being signed and China export rebate factors also coming into play, maybe, just maybe, there could be a start of a cycle in chemicals which have been floundering for the last 4 or 5 years. Is that even a possibility that can be predicted, or is it difficult to call that right now?
I think business cycles usually start when most entrepreneurs give up on capex, right? And we are seeing elements of that happen. You've also seen a slight bounce in terms of market capitalization of stock prices in some of these companies. But I'm sure we're very close to the bottom if we are not already at the bottom. Will this stretch, and will there still be a time corrective on this one? Probably so, at least for another 6 months to a year. But that doesn't mean that you will continue to lose money in this. So there are a couple of things that happens at the bottom of the cycle. One, you stop losing money. Two, there's time and price consolidation that is there. And three, capex in the entire industry has stopped. I think we are going through all three of that right now. When it comes to the Chinese, I think they're going through a similar cycle at this point in time. Okay, return on capital employed is fairly low. They lead the deflationary cycle in chemicals. Currency-wise, they've got a reasonably appreciating currency. So all put together, I think the Indian chemical businesses and the Chinese can take on the cost pressures that the Chinese are throwing at us, or the other low-cost countries are throwing at us. But we won't be profitable. I mean, we won't go from 0 to 50 to 100 in profitability overnight. It's going to be a gradual rise. It's going to be a gradual process that is there. You've already seen a lot of these companies deliver the volumes. Now they will have to make sure that these volumes change into pricing and pricing change into profitability. So you're slightly at the beginning of the cycle, or I think we are all trying to anticipate the cycle. We're close. I mean, it should be a part of your allocation, but I don't think but I'm not too sure how large a part of that allocation should it be.
Got it. Okay, Kenneth, what about this whole conversation around, this morning we were talking about it, but this whole conversation around if indeed the tech sector sees maybe pressures and job losses, what it does not just to tech as well as to, let's say, tech-focused real estate, but overall consumption growth, because that was the cohort, or that is the cohort that is present at the upper end of the K curve, air conditioners, two-wheelers, four-wheelers, etc. Is that growth, could that growth also come into question, or is it difficult to call that right now?
Okay, there are two scenarios here. One, if everything that we say is going to happen clockwork, you're going to get pressure in terms of how the consumer economy evolves. But that will be in pockets of the entire marketplace. Obviously, you'll have to reskill everyone to take it forward from here. But Neeraj, I just like to step back from I mean, there is a lot of macro noise out there. There are a lot of things that are happening with technology and what's its implication on long-term employment cycles are there. It is not only relevant to where India is, right? But all this technology changes that are happening are throwing up other opportunities that are out there where you just need to reskill and retrain your the entire cohort that works for these businesses, and things will normalize to an extent, not completely normalize to an extent. So wait, like I said in the entire at the start of this entire conversation, you've got to give it a little bit of time. In the near term, you won't see too much of pressures out there. In the medium term, you will see some element of how this industry will evolve. In the longer term, we will adjust to technology adaptation and rebuild other industries which are reasonably competent or can absorb this kind of or this trained skill set or this trained pool of employees that we have. So it's going to be a cycle. I don't think consumption is going to fall off the cliff right now, or at least from a point of view of where we've come from in the last 2 quarters, is going to fall off the cliff. You're still going to maintain that median of single-digit growth in volumes that are there, irrespective of whether technology falls off or not. Real estate has been driven primarily by the top end of the entire market or the premium luxury housing out there. These companies have to adapt to look for volumes over pricing, and I think we will move on. So we've been around for say 3 decades or 4 decades and seen how the country's adapted or how new technologies have come into play, and it's only gotten better. It hasn't gotten worse. So consider this: over the next 10 years, things will be better. It'll look very different, but it'll be better from what it is today. 20 years, it'll be even better from now. It's going to be different, which is why you have to get your portfolios which move in line with what the market cycles are or the market trends are. So don't be static. Any business that has been static has not been around for too long.
What's the take on IT, Kenneth? Can these companies survive? Would you look at the bellwethers doing better than the others?
Uh, so if I had to recreate a portfolio today, it would be zero IT. I'd still have a wait and watch approach, and then try and figure out what to do with this sector.
Okay. If you had to recreate a portfolio today, it would have zero IT. You're tempting me to then ask, what would a portfolio today look like? What would be in it if there's zero IT?
Well, it's in public domain, so we've got reasonable amount of pharmaceuticals out there. The second one that we've got out there is commodities. Okay, we start with metals, and then we're looking at a couple of soft commodities that are there in the basket. The third we've got is automotives. That's going through a reasonably good cycle, wherein you've got a single-digit growth domestically, but all incremental growth is coming offshore or with new markets that are there. So these are the three large positions that that are there on our portfolios. Okay, discretionary spends, I think it will hold. So any opportunity out there as far as some element of QSR, which is actually in a good cycle, I would say in a good upcycle, but it's a good place to be because a lot of that is already in the price. So I think that's a little bit of where contextually our portfolio is placed.
Got it. Can just a follow-up to that, the call to not have IT is because of the uncertainty around the sector combined with the valuations the way they are, and would the stocks at a particular valuation multiple be looked at?
So the argument from a valuation standpoint is how much would the terminal value of these companies be? Right? And if they're non-existent or they have a very low terminal value, if there's not much value even at the current price, right? So again, it's becoming slightly like what we had in BFSI. Okay, it's going to be a place where you will look for companies that will come through in the next cycle, and there will be a number of them that do exist today that will be much larger in a decade from now. So I think we just have to recalibrate. So when I say that if I have to build a portfolio today, it will have no IT in it. It doesn't mean that we are bearish on where the cycle is. It's cheaper than it's ever been. That's a positive. But we'll just have to recalibrate business models to see what will make us a large amount of money in the next decade. So we will get back in at an appropriate time with and more importantly, with an appropriate business.
Get back in time with an appropriate business. Kenneth and Radhe, thank you so much for speaking with us. You have very succinctly explained the, I would say, nervousness in the markets that we're seeing as well, and uncertainty more than nervousness about where things are going next. We saw that in the Nifty right now as well. Kenneth and Radhe there, thank you.